Hi, it's Mike here, and today's video is a summary of the latest financial news and the practical application of the rules to follow when investing in stocks. The first thing I'm going to do today is to look at a chart of the US Treasury yield over the past week, and it shows that the yield has been falling for a week. This is very good news for stock investors. All three major indexes rebounded more than 2%. According to Stock Traders Almanac, October marks the beginning of the best 3 months of the year, according to historical data, which calls it the month of bargains. The period between early October and the second trading day of January tends to record significant price increases. Indeed, if you look at the monthly performance over the past 50 years, October, November, December and January are the very best performing months of the year, so the entry point is this month. S&P 500 has rebounded in a big way. It's once again exceeded the previous low, which has been the lowest point of the index. Nasdaq has also some positive movements, and as you can see, it's holding up here after exceeding its lowest point. This is the QQQ index chart, and it just touched the 200-week moving average line. Crude oil prices rebounded today. As a result, if you look at today's sector performance, all sectors are up, but especially the energy sector, which is up almost 6%. This is the performance of the indexes since the beginning of the year. S&P 500 is down more than 22%, and the Nasdaq is still down over 30%. The US Fear Index has now dropped to 30 after rising to 35. Some of you may ask, why did you change your opinion when the VIX has not even reached 40? But the VIX is only one of many indicators, and what we should be looking at first and foremost is business performance and interest rates, especially interest rates. This is because interest rates are 70% of the factors that determine a stock's price, and business performance is only 30%. So, of course, it is important to check the daily and moving average put-call ratios. But far more important is to check the daily interest rates. And the day when I changed my opinion, I noticed that long-term interest rates were starting to drop. When all investors shrink, they take refuge in bonds, so long-term interest rates fall. Then comes the recession. And as I have told you many times recently, when a recession comes, stock prices go up. For the short-term market outlook, the target for S&P 500 is 3,900. Its closing price was 3,678. The US market has been soft for some time now. Market participants are concerned that inflation is not slowing down. The Fed is focusing on PCE inflation, among other things. But prices rose 0.3% in August from the previous month and 6.2% over the past year. The mindset of market participants has been quite fragile due to the daily declines, and the bulls have been overshadowed. However, a study of the past bear markets shows that in the majority of cases, a major bottom was reached in October. Many in the market fear the onset of a recession, but in fact, we believe that a recession is the news needed for the market to bottom. The reason for this is that the Fed raises interest rates to keep inflation down, and recession usually works to push prices down. In other words, bad news is more likely to be taken as good news than the opposite. Housing sales have already cooled because mortgage rates have risen sharply, making it more difficult for borrowers to afford their loans. Energy and grain prices have also fallen significantly. Therefore, there is no doubt that inflation will subside on its own after some time if things remain as they are now. As long as inflation subsides, I think it is okay to buy stocks. State of the US economy is overall getting dark. However, only employment is exceptionally strong. Of course, low unemployment is a welcome sign, but when wages are rising so fast, the Fed can't ease off lightly. Therefore, pay attention to the average hourly wage figures, because the idea that wage inflation is habitual is deeply rooted among Fed members. One after another, companies posted their financial statements, reporting lackluster results due to the strong dollar. We can say that this was the worst earnings announcement season since the new coronavirus pandemic. In spite of this, the consensus EPS expectations has not yet come down sufficiently. Here's the forecast for 2022 and 2023. As you can see, it's rising. The recent strength of the dollar is a negative factor for high-tech companies that generate a lot of overseas sales. Therefore, we need to remain vigilant during the third quarter earnings announcement season, which begins in mid-October. I expect the ETF market to be higher than it was in September. The point is that the market will be higher, regardless of whether the news are good or bad. Therefore, I think it's time to buy some ETFs, like these ones. Let's be bullish this month. Jim Cramer's Real Money: Sane Investing in an Insane World. Personally, I consider this book as one of my investment Bibles. I would recommend reading this book to all who are beginners to investments. In it, there are 25 rules to follow when investing in stocks. These are advices for long-term investing. Rule number 1. If you get too greedy, you will fail. Bulls, bears make money. Pigs get slaughtered. Rule number 2. It's okay to pay the taxes. Stop fearing the taxman and start fearing the loss man, because gains can be fleeting. Rule number 3. Don't buy all the stocks at once. Cramer says investors should not buy everything or sell everything at one go. It is best to buy and sell stocks in stages, so that an investor can get the overall best prices over time. Rule number 4. Buy damaged stocks, not damaged companies. There are no refunds on Wall Street, so do your research and focus your trades on damaged stocks rather than companies. Rule number 5. Diversify to control risk. Cramer says it is only through diversification that an investor can avoid getting nailed by sector risk, which is about 50% of the entire risk of owning a stock. Rule number 6. Do your stock homework. Before you buy any stock, it's important to research all aspects of the company. Rule number 7. No one made a dime by panicking. There will always be a better time to lead the table, so it is best to avoid the fleeing masses. Rule number 8. Buy best of the breed companies. Cramer advises investors to buy shares of the best of the breed companies, even if it means paying more for their stocks, as the best-run companies with best prospects can help protect portfolios and minimize their losses. Rule number 9. Defend some stocks, not all. When trading gets tough, pick your favorite stocks and defend only those. Rule number 10. Bad buys won't become takeovers. Bad companies never get beats, so it's the good fundamentals you need to focus on. Rule number 11. Don't own too many names. He advises investors to stick to only a few positions that they know inside out, and never buy a new stock without selling off another. Rule number 12. Cash is for winners. If you don't like the market or have anything compelling to buy, it's never wrong to go with cash. Rule number 13. No woulda, shoulda, couldas. According to Cramer, the worst thing an investor can do is let a mistake undermine his confidence. Rule number 14. Expect. Don't fear corrections. It is not always clear when a correction will strike, so expect and be prepared for one at all times. Rule number 15. Don't forget about bonds. He says it is very critical to always keep an eye on the bond market, as bonds are a tool for capital preservation. Rule number 16. Never subsidize losers with winners. Cramer believes it is essential for investors to not get attached to their loser stocks, especially when they need to generate cash. Rule number 17. Check hope at the door. The Wall Street veteran believes investors should never base their decisions on hope and should leave it behind before entering the stock market. Rule number 18. Be flexible. Recognize and be open to the unexpected shifts in the market, because business by nature is dynamic, not static. Rule number 19. When the chiefs retreat, so should you. High-level executives don't quit a company for personal reasons, so that is a sign something is wrong. Rule number 20. Giving up on value is a sin. If you don't have patience, think about letting someone who does run your money. Rule number 21. Be a TV critic. Accept that what you hear on television is probably right, but no more than that. Rule number 22. Wait 30 days after pre-announcements. Pre-announcements signal ongoing weakness. Wait 30 days to see if anything has gotten better before you pull the trigger to buy. Rule number 23. Be aware the Wall Street hype. Cramer warns investors against underestimating as to how a stock may get a big push on Wall Street. Rule number 24. Explain your peaks. Buying stocks is a solitary event, too solitary in fact, so always make sure you can articulate your reasoning to someone else. Rule number 25. There is always a bull market. Cramer believes there are always going to be some hidden sectors and industries which will be doing well despite the rest of the market being down. There are many other useful rules in this book. You can find it on Amazon. So that was it for today's video. If you enjoyed it, subscribe and hit the like button. See you in the next one.